Hey there, my name is John Stevenson, and welcome to the Guaranteed Retirement Guys show. Today we're going to be answering the question on whether or not MYGAs, or what we call multi-year guaranteed annuities, are they better than CDs? All right, so if you have CDs that are maturing, you might be looking at the renewal rate, and you might not be very happy with it because rates are going down. And so you might be looking elsewhere for higher growth options. And if you've looked at or even considered a fixed annuity or a MIGA that has a fixed rate of return for, anywhere from 2 to 10 years, they're very, very favorable right now compared to a CD. And how favorable? I'm going to show you here in just a few seconds on my computer screen, and I'm going to show you all of the rates. I'll show you different years that are probably best as far as locking in the highest rates. And then, of course, if you're looking to purchase one of these and you're looking for some more growth for your retirement or just maybe some protection, then reach out to me. There's a link below this video, and there is also a link on my website, johnstevenson.com. You can also search the current MIGA rates on my website there as well, and you'll be able to research, kind of find out what the rates are, and then if you feel comfortable and you want to reach out, then go right ahead. All right, so let me share my screen. I'm going to show you exactly what they're paying right now. Okay, so I didn't put any filters here. You notice that there is, this is just the first page of a bunch of different MYGAs, and I'm just going to go through different terms. And I'll start with a 3-year term. Okay, you can get a 1 and a 2 year, but I usually recommend if you're going to go for a short amount of time, do a 3-year. You can do shorter than that, but at that point, you might be better off just throwing it into a high yield savings or money markets. Yeah, you're not earning as much, but it's just such a short amount of time. Usually you want to have that liquidity, but that's up to you. All right, so for illustration purposes though, I'm going to show you the 3-year first. Now, the other thing to remember with annuities is they have different rates depending on the term that you lock in. From my experience, it's usually the 5, 7, or 10-year options that pay the most. They usually have the best rates. And so I'll show you those here as well, but I just wanted you to kind of see what they're paying now. Rates change all the time. Sometimes they raise them, sometimes they lower them. It does, obviously it is influenced from what the Federal Reserve decides to do. But at the same time, they're always, at least from my experience, they're always little bit better than a CD. Sometimes a lot better, just depending on the bank that you're with. All right, so looking at the 3-year, we are seeing, 5.45. That's not too bad actually for a 3-year. You can see Exonic, Revel 1 has a couple options, Nighthead, Equitrust, American National, Clearspring, and so on. So there's a lot of good options for the 3-year, and you'll notice that some of them don't have a withdrawal. Okay, this one with Revel 1 does not allow it. But there is one that pays a little bit less, 5.35 versus 5.45, that will give you interest only. So there is a cost to accessing your money. If you want to let it sit there and you want to park it, then just pick the highest rate. And it just so happens that the highest rate on this list is Exonic. So Exonic's pretty good, 5.45, and they allow a 10% free withdrawal after the first year. So that's the other thing you need to think about as well. Anything that shows interest only, then that's immediately, if you want to live off that interest, 10%, same thing. But anything that says first year, then it applies to the first year. And then usually after 12 months, they will let you do it. Just depends on the annuity contract. All right, so let's look at 5 years, because 5 years is really what I would recommend, the minimum that you do, because you usually get better rates. Okay, yeah, you do. So 5.75 with Revel 1, followed by Exonic. Now, this one does not allow withdrawal. So if you're thinking, well, I want to live off the interest, okay, then you're probably going to pick Revel 1's 5.65. Okay, so 5.65 interest only, that's pretty good. So let's, but here's the thing on this, and I just wanted to revisit this. When you look at my rates on my website, you're going to be looking at simple interest and you're going to be looking at compounded interest. Sometimes you'll see two different rates. You'll see a base rate and you'll see a yield to surrender. And you're thinking, well, what the heck is that? Like, why is the yield to surrender so much lower than the base? It's because the base is a simple. Okay, if it's paying simple interest, it's just, you put 100,000 in, you're gonna get, and you're getting 5% interest, and it's not compounded, then you're gonna get $5,000 every single year because it's based off of the initial principal. It doesn't compound. So a lot of times, if you get a higher simple interest rate, it will still have an overall lower yield versus a lower rate that is compounded. Okay, so keep that in mind when you're looking. Now, if you're taking interest out every single month, then who cares? Get a simple interest and get as high of amount as possible. All right, so if you're looking at this one, let me just pull it up so you can see the growth. All right, so 5.65. And again, I put 500 grand in here. So I put California, I put 500,000. Your amount could be whatever. I mean, I sell these millions of dollars into one or several of these, or $100,000. So it just depends on what you're looking for. Typically, there is a low, mid, and high band rate. So the more money you put in, you typically lock in the higher rate. Okay, so here are the earnings based off of 500,000. It's 28,250. Okay, then 29 and 31 and so on. If you let it compound, it'll grow to 658. If you don't, and you just take the interest out, then it's gonna be $28,000. So it's not bad. You can live off that and get your $500,000 back at the end of 5 years. But let me go back to here. I just want to see, because Nighthead, a lot of times Nighthead will have a simple interest. I just want to see if they do. Let's see here. All right, so it looks like they might. Let's look here. Yep. Okay. 6.2. But you know what? It doesn't allow free withdrawal. 6.2. So yeah, I wouldn't get that if I wanted to take withdrawals. So let's see the 5.1. And again, this is showing yield to surrender. You'll notice this one 5.55. This was the one that was paying. What was it paying? It was paying 6.2. So that's the difference when you see yield to surrender. You're saying, well, why is it so low? It's just because the earnings are the same. They don't compound. So you want to look at that. If you care about the end balance, then focus on compounded growth. If you don't, focus on simple. All right, so we'll go back in here and we'll say, all right, well, what about the 5.1? Okay, so simple interest, 5.65, 5.1. So you're getting roughly the same amount. So I'm just saying, if the simple interest was higher, like 6%, then this would be a better option than the first one we looked at 5.65. But just looking at this, it looks like it's about the same. So just things to think about when you're looking at MYGAs and you're comparing those to your CD. The other thing I like about MYGAs is if you have cash and you're putting it into a CD, you know you're going to be taxed on that growth every year. But with a MYGA, it's a tax-deferred vehicle, which means you can tax defer it and you can do it for as long as you want. Which is great for non-qualified money. You don't have to pay taxes on it. It kind of acts like an IRA. You get the benefits of it. But eventually, of course, when you start taking money out, you're going to be taxed on those earnings first because it is taxed on a LIFO basis. So last in, first out. All right, so let's go in here and look at, I want to look at the 7 years just to see what they are. I left Nighthead in there just because I wanted to see what their simple interest, see if it was any better for the 7 year. Oh, look at that, 5.85. So guaranteed yield to surrender is 5% because they're comparing it to, if you were to let it compound every year, then it would be the same. It would be the same as earning 5% compounded. So that's what that means. But simple interest, if that's what you're looking for, which this one allows withdrawals, look at that. It's $29,000 a year. So it's definitely more than the 5 year, and you lock in a higher rate for longer. So if you're worried that rates are going to go down, this is a good option. Okay, 5.85 is pretty good. And you're getting that, and you're pulling out $29,000 out a year, and you get your $500,000 back. Or if you let it just sit there and grow, it'll be at 704, 750 at the end of the 7 year term. All right, so I just want to show the highest rates of the 7 year, no matter what, simple or compounded. All right, so Revel 1, that's not bad, 5.75, no withdrawal. So if I look at just one that compounds, let's see any balance for this one. All right, a little bit higher, $739,000. So you can notice in the beginning, the earnings are like $28,750, but then they compound and grow pretty large over time. So that's nice. It's definitely nice to have. But of course, that is without any withdrawals, okay? You want to get something, if you do want withdrawals, some people don't, but if you do, then you got to focus on that as well. So you can see Revel 1 is paying us 5.65, interest only. Let's go to the 10 year. Let's just see what that looks like. Sometimes they're not as high, but you're locking in a higher rate for longer. Okay, so 5.5, Equitrust. Okay, interest only. So at least we get the withdrawals. So this isn't a bad product. I got plenty of clients with Extra Trust. They're doing quite well with them. You notice the earnings start out a little bit lower in the beginning, but over time it compounds pretty good. Okay, by the end of the term, your last compounded amount is $44,000, and you've earned a total of $354,000, making your balance $854,000 at the end of 10 years. Pretty nice for compounded growth, market protection, and of course, if you want to take money out and live off the interest, you can do that too. So it's pretty nice. Let's go back here. I want to see. I'm just curious if Nighthead has. Nope, they don't. Okay. Well, some carriers do, some don't. Some of them focus on certain terms. Others sometimes offer all of them, but it just depends on what you're looking for. So the best way to find out really the best options for yourself is to go to my website. Go to johnstevenson.com and check out the rates. Okay, go to the MIGA calculator. One other thing that you want to remember is these are state specific. Okay, so a lot of them are available in the same state, but some of them are not. Okay, so if I go over here, like this person's based out of California, but what if they're in Nevada? What if they're in my state? Okay, we do that. Let's take a look at this. Okay, look at this. Nevada, you can sell Wichita and Revel 1. See, look at that. So if you're in Nevada, I can sell you one as high as 6%. It's a B plus company, so it's a little bit higher risk. You got to realize that. So maybe keep it in the state guarantee levels. Maybe keep it at $250 per contract. So, but yeah, it's not bad, not bad. So you go down here and say, all right, with interest only, still Farmers Life 5.8. That's great. That's a great rate to lock in. I've got clients with Farmers that are doing well. And you can see the payout here. Yeah, $29,000 if you want to strip it off. Otherwise, let it grow and compound. It's $878,000. Okay, now let's go back and we'll say, well, what if it's a 7-year? What are the 7 years paying? Look at this, American Gulf, 6.3. Wow, that's pretty good, but they don't allow withdrawal. So if you want to add the withdrawal provision, they allow you to do it after the first year, and then they pay you 6.15. So you just have to wait 12 months to take income. Some people don't want that, but if you're willing to wait that long, then your earnings are going to be $30,750. So you'll wait 1 year, pull out $30,000, $30,750 every year, and then get your $500,000 back at the end of 7 years, or let it compound, and it'll compound to $759,000 over 7 years. All right, let's go back and we will look. Let's see the 5-year, just see if it's comparable. Yep, it is. And you can see the same, American Gulf, Wichita. You got different variations of the same offerings here. Mountain Life is in here. Wichita. Revel 1, just, and then if you're thinking, well, I don't know, John, I want an A-rated company, right? I want someone at least A-. Well, we can do that. Just filter that out and say, all right, well, the highest A- for a 5-year is paying 5.7. Allows 10% after the first year. Okay. If you want interest only in the beginning, then it's Royal Neighbors. Keep in mind with Royal Neighbors, they are a fraternity or an organization, which means they are not covered by the state guarantee insurance. So that's one thing to remember. They're a great company. They're $1 billion in assets. They were kind of started for women. But you just have to remember, if you want that protection from the state, then, pick a company that has that protection. So the B++ companies, they all have that protection. So a lot of times people will just park their money in there knowing that it's for a short term. And a lot of these companies are 50 years old. Some are much older than that. And they just invest in a little bit higher yield bonds. So anyways, hope that helps. If you have questions, let me know. Comment below if you got questions. If you like the video, like, subscribe, share. And if you want to purchase an annuity, then book a call with me. There's a link on my website, johnstevenson.com. I'm not going to bite. I'm not going to try to hard sell you anything. But if you are wanting to work with me, I'd love to help you. So that's totally up to you. But what I'm trying to do in these videos is just share as much as I can, because you're probably browsing the internet, you're looking around, you're talking to advisors, and you're trying different calculators, and you're like, man, this is a lot of money. I don't know who to talk to. I don't know who I feel comfortable with. You just got to go with whoever you're comfortable with. Okay. What I'm trying to do is just share with you the best options that are there. And of course, I'd love to help you if that's something that you'd like to do. So anyways, hope this helps. Thanks again for watching, and we'll see you next time.